What we want to talk about today, and we've got 60 minutes, is to talk about some of the strategies to access capital here in 2011. And as we start, we're going to try to hit these topics here. We're going to talk a little bit about the credit bubble, and we're going to talk then about what happened with credit contraction here in the last 3 years and how that's impacted ministries and your ability to obtain funding. We're going to talk about what it all means right now in the current world for project funding for your church. And then we're going to talk about strategies. That's really what we're going to focus on a lot, is the strategies for obtaining capital, accessing capital for projects that you may have planned. So let's start out. I always like to talk about this because I think it puts things in perspective. We all know that the U.S. is in somewhat of a downturn the last 3 years on the economic side. And one of the reasons is that we had a very large credit bubble. And starting around 2003, give or take, we had the Federal Reserve lower interest rates down to 1%. We also had some different factors going on. We had some growing economies like China, Middle East. They were exporting trillions of dollars in goods and services, and we were paying them in dollars. So they had a lot of dollars, and they were reinvesting it in this country in different projects. We had investors coming off the 1990s in the tech bubble who were used to getting double-digit type annual returns on their stocks. And so in that 2003 era, really post 9/11 era, only low returns were available. And so you had a lot of dollars chasing a lot of projects. And so all types of projects were being financed. You had the subprime home loan industry had been created in that bubble period and financing all types of residential construction. You also had commercial construction, and you had church construction. To give you a perspective of how big a bubble we had in the lending industry, this chart shows the amount of credit available at all the commercial banks. And you can see we start back in 2002, we were at about $5 trillion. We then peaked out in 2008, right before the crash, we peaked out at close to $9 trillion of commercial credit. And you can see how quickly that bubbled up. And now we've been in somewhat of a holding pattern where we've been in a fairly regulated environment here the last 3 years, with the federal government participating quite actively in the credit markets at the moment as well to kind of keep things supported. There was a big contraction, though, that took place. And what happened was many of the loans made during that bubble period began to season with bad results. People were defaulting. The first part of it was the home mortgage market that fell apart with the subprime homes. And then in 2008, you had the banking crisis and the commercial real estate market. Those loans started to non-perform, including, obviously, the church loans. And so that's kind of where we are today. I'm going to talk, though, a little bit about some of the changes, but this gives you an idea of commercial loan delinquency rates. And you can see how commercial lending, typically, and when I say commercial lending, referring to churches included in there, you can see how everything was historically always at about a 1% default rate. And all of a sudden in 2007, a lot of those loans that were made, you can watch these default rates spike up to now where you're up in the 8-9% range. And so until these delinquencies work themselves out, we're going to continue to have a little bit of impaired credit here in the U.S. What does the new environment look like? Well, a couple good things. I mean, the market has improved quite substantially in the last 3 years as compared to where we were coming off the crash. There are a number of banks and bond underwriting companies that are lending to churches. Now, there's fewer firms in the marketplace than there were 5 years ago. That said, there's a good selection of lenders out there. There's a number of us when you tour the exhibit hall that you can run into, and obviously any of your local banks in your community that you work with. Few things with the new environment. Loan multiples are down, and I'll talk about this more in a second. Historically, church lending had been done in loan qualifications of 2 to 4 times income. So if you were taking in $1 million in tithes and offerings, you typically could qualify for between 2 times or $2 million to 4 times or $4 million of financing for a major building project. In the bubble, we were hitting points where loans were getting done at 6 to 8 times multiples, and those just weren't sustainable. Next point I note is back to the future. When we at Ziegler did the original loan for Saddleback and Rick Warren back in 1992, that was a phased project where we did one loan in 1992 for them to buy the land, do a lot of the site work, and then Saddleback put up a large, somewhat permanent tent that they used for their worship. They came back 2 years later, and at that time, 2 years later, is when they built a permanent sanctuary. And that was a good approach. It was a conservative approach as they took over time and sort of grew into it. What we hit in the bubble was so many churches felt like they needed to do the entire multi-master campus all in one shot. And these $30 million, $40 million projects were hatched, and for a lot of churches, it was too much to bite off. So we're seeing a lot of phased projects now at this point. Credit spreads are a little bit wider, and by that I mean if your church has a very strong credit, you'll pay a little bit less in the way of interest rate for a comparable loan than would a church with a bit of a weaker credit. I know that sounds very intuitive, but during the bubble, that wasn't necessarily the case. I mean, weaker credits were paying about the same rate as the strong credits. The money was flowing in, and there really was not a lot of distinction there. Great news. Of all the problems we've got in the economy, there's one really silver lining here with all of this. Rates are at historical lows. So if you can obtain funding, now is a great time to borrow. More equity cash typically is required. And I think one of the biggest concepts that I want to talk about with you today is understanding your debt capacity. That's really a key thing. And understanding your debt capacity is important because when you talk with a lender, you want them to understand that you really know what you're getting into, that you've looked at things, you understand what this loan's going to entail, what it's going to mean for your ministry, what type of cash flow you're going to have, and you want to put your best foot forward. And you don't want to go in there and ask for a $12 million loan if your church can only qualify for $2 million. And so we're going to talk a little bit now on how to do that. When we look at a typical project timeline for a church, it really works along these parameters. You've got the church realizing that there's a need for a building, committees meet to discuss a project, and churches typically at that point are going to go ahead and hire an architect. Well, then we go into these next steps where the church is going to hire a fundraiser. Church may vote on the building project with the membership if you have that as part of your bylaws, and then typically they'll go get some additional architectural plans commissioned. Well, now here we get to these last ones. The fundraiser commences, pledges come in on a pledge Sunday or First Fruits Sunday, and then construction begins. One of the challenges with financing for churches is that we as lenders typically get calls right around here at step 9. And the reason for that is that a lot of churches are not able to, they may think they can raise all the money on Pledge Sunday, but maybe they find out they can't. Or what they find out is that when they actually get ready to build, they find out that the actual construction contracts come in quite a bit higher in cost than when you were at these points of the development with the architect. And so what we always encourage is that before any of this starts, really when you get up here in parts 1 and 2, that you start analyzing your debt capacity. And that may involve talking with a lender and getting some feedback from them. Debt capacity is being the single most important factor with new projects. Because buildings are so expensive these days, most churches do need to borrow. And so when you look at the costs of a project, you've got architect fees, you've got the time and talent of the people in your organization, you may have a professional fundraiser. This is a big one, political capital of management put on the line with your donor base. You don't want to go out and tell the congregation, we're going to get this big, beautiful new building, you've got the 3D renderings up, and then find out it's not financially feasible, because that really can hurt the momentum of a church and hurt your leadership team. So managing the timeline of these events is important, and that's why coming back, talking with a lender, and understanding your debt capacity is critical. So now we're going to talk a little bit about debt capacity. There are a few key tests with debt capacity that once you understand these tests, it's really going to help you get comfortable with borrowing, feel confident when you put that loan into place, and really feel confident when you go out and talk with your congregation on the project. So the first test that many church lenders look at is that total revenue to debt test that I had mentioned. And what this essentially means is take a look at what your total revenue was last year. Now don't include, if you have one-time events like a land sale, maybe it's a major gift, loan proceeds, you don't include that. You really want to look at your core tithe and offering base. Now, historically, most church lending, safe church lending, has been done where the debt support level has been 4 times, not more than 4 times last year's general giving. Sometimes capital campaigns can be counted in there as credit if there's something that's been fairly recurring. So as an example, we've noted up here, let's just say a church has $1.5 million of last year's total revenue, and they could possibly qualify for up to a $6 million debt load. As I noted, some lenders in the bubble went as high as 6 times or 8 times multiples. And those really got too high, and some of those churches right now are struggling and did get over-leveraged by this. A conservative base to start with is a 3 times factor, or to say $1.5 million revenue base supporting about a $4.5 million loan. Now there's a second test that you overlay, you should also calculate independently of the revenue test. And this one is your debt service coverage test. For most lenders, they want to know, do you have enough free cash flow coming through your ministry to be able to pay on a mortgage? And so for those of you who are familiar with stock modeling or different cash flow modeling from accounting, there's a term called EBITDA that's very popular, and we use it in the church lending industry as well, and that's your earnings before interest, depreciation, and amortization. Now, in the for-profit world, there's a little T in there, EBITDA, which includes taxes. But since you're a nonprofit, churches do not have any type of tax burdens. So let's take a look at how this is calculated. As we look at the slide here, our hypothetical church has $1.5 million of tithes and offering income, salaries $500,000, programs $300,000, missions, utilities, insurance. The total operating expenses for this church last year was $1.1 million. Now, if we take the offering income and revenues less the operating expenses, we come up with an EBITDA number of $400,000. And I would just tell you, in this example, this is a very healthy example for a church cash flowing. And as a lender, what we do is we look at this and say, wow, they've got $400,000 that they theoretically could use to service a mortgage that they took in last year. Now, that $400,000, you may have spent that on architectural plans, you may have saved that, it may have gone into a project cost that's capitalized over a period of time and not expensed out. But you add in then the depreciation and interest, and here's your bottom line. But we're not looking at the bottom line, we're really looking at what the EBITDA is. So now we'll look at a different church with very similar numbers, but there's one small change. Same church with $1.5 million of revenue, but here's the difference. This church runs a much more healthy salaries and programs bottom line. Their operating expenses are $1,475,000. That means their EBITDA is $25,000. Now, what's important to note is that most churches do not, obviously, as you know, you don't run a profit. I mean, money that comes in, typically it's spent. From a lending standpoint, though, we as lenders like to see some cash flow saved up before you come in to borrow, to get that EBITDA to show that once that loan is in place, you have the cash then to make the payments on the loan. So let's just take a look hypothetically for this church. Let's say this church takes out a $4 million mortgage, or wants to apply for a $4 million mortgage that would require annual mortgage payments of $300,000 a year. As a lender, we would look at this structure and say, boy, how is this church going to come up with $300,000 a year in mortgage payments? Their EBITDA was only $25,000. To get that $300,000, you're either going to have massive growth in the new building, which is possible, but we can't always count on that immediately happening, or they're going to have to cut back expenses. And they might have to make some very significant cuts that might cause a bit of turbulence with the staff and with your congregation. So for this type of structure, if your numbers are coming in this way as you're calculating your EBITDA, you want to look and try to figure out, okay, how can we get our EBITDA up? Well, we can look at cutting some expenses in the next year. We can look at increasing our revenues. Maybe we bring in a building fund to help bridge the gap. And as a lender, we'd certainly look very favorably on a building fund that came in with the funds perhaps being used for debt service. Before I go on to the next slide, questions so far on the debt to revenue or the EBITDA tests? okay? Well, now we've talked about two tests. There's another test that we overlay, and this one, again, is a good one for everyone to understand in the room here. This is the debt capacity test, and there's no, obviously there's no universal truth to church lending. That said, we think, for our company at least, being in business lending for almost 100 years, we've come up with some ratios that the industry is fairly comfortable with that really have proven out. And this one, this part 3, is what we call a 33% test. The idea behind this is to look at what your mortgage payment is and to make sure that your mortgage payment on the loan you're taking out, the annual cost, is not more than 33% or 1/3 of last year's total revenue. The reason for that is that balance historically has served churches very well because it's given you a 67% cushion of other available revenues in your budget to go towards programs and ministries. And so, as you're looking at things here, if you've got $1.5 million, we'll go back to that other scenario, $1.5 million of revenue coming in, and you take out a mortgage that requires you to make annual payments of $750,000 a year, or 50% of your revenue, that's a really tough go for a church. Tough go to serve your people, do ministry, and it gives you no cushion if you have a downturn. If you have a major giver leaves or major family loses their job, you're really stuck. And so we look at all these tests, the 3 tests, and we try to kind of weave them in so that your payments, again here, proposed payments on a mortgage would be 33% or less of last year's income. Now, as part of the 33% test, there's something that interplays into this, and that is interest rates. Because if interest rates are lower, it's going to mean that your payments required are lower, and thus you have greater potential borrowing capacity, at least under the 33% test. And so one of the things that you want to do is, as you're looking at the 33% test, here we've got a sample mortgage of $4.5 million on a 25-year amortization. The interest rate on that mortgage is 5%. It works into a monthly payment of $26,000, and it works into an annual mortgage payment of $315,000. That's a very good ratio, because right there, that $315,000, as you can see, that's only 21% of $1.5 million. So we've got a lot of cushion before we get to 33%. But what you want to do, though, is make sure that you can handle the interest rate sensitivity if the rate on your loan changes. And so let's say that this same loan here has a rate that either initially starts at 8% or rises, gets reset to 8%. Now you're talking $416,000 a year of payments, and so suddenly your 33% test, if you're following along, jumps up to 28. So you want to always be aware as you get into these things what your interest rate risk looks like. That's really important when you look at rates where they are today. What we have up here is a graph, last 30 years, the historical rates of the United States government's 5-year Treasury bond. Now, many banks and lending institutions will use different indexes which they base their loan rates off of to you, the church. Some banks will use a prime rate, which most of you are familiar with. Prime rate today is at 3.25%. Just a couple years ago, it was as high as 8.25%. Put in perspective how far we've come down. The 5-year Treasury is another one that a number of lending institutions will use and will base their rates either directly or loosely off of. And the 5-year Treasury amazingly hit a low about 7-8 weeks ago of 0.77%. So we are at the bottom of the last 30 years. The average over that 30-year period is 6.24%. The high is 16.27%. I think the key point with this chart is it puts into perspective how good rates are right now. It also should make you, as you go out, if you embark out to borrow money as a ministry, realize that your chance for potential downside with rates readjusting in the future is significantly greater. There's not really much upside left on interest rates at this point. And so as you're weighing out your choices of how you're going to go fixed rate or floating rate, keep in mind that if you can only afford a project at a rate in this area, you may want to give a little bit of pause, because if that rate does reset later down the road at any of these other points, it could be quite a shock on your budget. And so, again, that's something that we just encourage you to look at and be careful with. And so now we come into interest rate stress testing. This is the last of the four sort of tests that I think will, again, help you understand your cash flow and help you talk with lenders. Do an interest rate stress test. Figure out what we can afford. And so let's say we start out with this mortgage here, same $4.5 million. This time we're going to take a floating interest rate. It's going to adjust monthly. And right now it's at 3.75%, let's say. Or maybe it's an annual fixed rate for a year or two at 3.75. The annual mortgage payment is $276,000. Now, if that loan, let's say, resets either next month if it's a floating rate, or maybe it resets in 3 or 4 years if it's a sort of a mini-term fixed rate, what you want to do is see how much stress can we take on our payments if that occurs. And so here, let's say this thing goes up 6 points up to 9.75%. All of a sudden now your payments are up at $477,000. And so this is the kind of exercise that you want to do with your team to see whether you want to take a fixed rate or a floating rate. Because right now, short-term rates, under most economic conditions, shorter-term financings do bear a lower rate than a longer-term fixed-rate financing, under most conditions. Not always. There's times where we have what's known as an inverted yield curve where that phenomenon doesn't exist. But that said, what you want to weigh out is to figure out how much stress you think you could take in the future on your budget. And if you feel you can't take any stress, then you want to look at something that's a long-term fixed rate, might even be something like a bond issue where you have a 20 or 25-year fixed rate. If you think you can handle the stress and take advantage of the floating rates where we're at, you may want to go this a bank route with a 1-year adjustable or something of the like. But only you can make the decision of what type of risk tolerance you have and risk ability that you have in your budget. One of the key factors is noted here, which is determine how quickly you can pay down the debt versus your other ministry cash requirements. And what this is kind of getting at is, if you're a church with a $1.5 million budget and you take out a $1.5 million loan, that's not a very big loan in the ministry lending world. And so you shouldn't get into a whole lot of trouble taking out a short-term or a floating rate lower interest loan. If rates rise, odds are you can generally cover it with that type of budget. However, if you're borrowing $10 million, that's a whole different story. A $10 million loan, you have a 1% increase in interest rates hits you on your loan, that's $100,000 a year of additional cash flow that you have to come up with. And so go back to the example I was just talking about with the prime rate. The prime rate a couple years ago in 2007 was at 8.25%. It's now at 3.25%. Let's say your bank that you're working with happens to use the prime rate, and you have the prime rate go up 3 points on your $10 million loan. That's a $300,000 hit to your bottom line. Not many borrowers can handle that type of hit. So that's why you have to weigh out all the factors. I wanted to talk about this with one slide about interest rate swaps. How many of you have an interest rate swap or have looked at one with your borrowing arrangements? Got a couple hands in the air. I don't want to spend a great deal of time on it, but I want to at least just give maybe a 2-minute overview, just so everybody's dangerous enough to know a little bit more about them. But they're a very common tool that borrowers can use to hedge risk on floating rate risk on your loans that you might take out. And what a swap does is, in effect, it's a separate instrument from your loan that can be used to fix help hedge. Doesn't fix the interest rate on your loan, but it can help hedge against the interest rate on your loan going up or down. Swaps, if you don't take anything else away from today on swaps, take away these few points to know that if you enter into a swap, it is a separate instrument from your loan. It's not the same as your loan. They're two totally different contracts that you enter into. Also note that swaps can act independently from your loan. They are unrelated and they don't necessarily always correlate. With a swap, if you take a swap, understand how your unwind fee is calculated, because a swap is a hedge contract. It's a derivative that you buy to hedge yourself, your church, against interest rates going up on your particular loan. And so they always typically have unwind fees built into them. Now, sometimes if interest rates move in a particular direction, things can work out where you could actually prepay your note, unwind your swap, and get a premium on it. But I don't know, has anybody in here ever gotten a premium on a swap contract you've taken out? If for any of you have, did you or no? Absolutely not. Well, I pointed out because there are some bankers who, you know, when you go to the bank to get a loan, and you're talking as we have on interest rates, and you say, I'm worried about rates going up, I'd like a 5-year, or maybe I'd really like a 10-year fixed rate loan. The banker may say, well, I can maybe get you a 5-year fixed rate. To get you a 7 or a 10-year fixed rate, we're going to have to enter into a swap contract. But don't worry, because then you'll have your rate fixed for 10 years. Great news, everybody's happy. What you have to understand is that most commercial bankers, I would say, I don't know, I don't know if I want to say most, but many do not really understand how a swap works. And so there's so many churches, countless of them right now, that took out loans at some point in the last 2, 3, 4, 5 years, even in the last year, and then they decided they wanted to refinance with rates down, and what they found was they had a swap contract tied to their loan, and it had a huge unwind fee, perhaps in the hundreds of thousands of dollars, that's prevented them from refinancing their note. Swaps are a really tricky instrument. I'm not discouraging someone from saying don't do swaps, but do them only if you understand everything about them. And we could talk for hours in this seminar on them, so I'm going to just leave it at this just general topic. If you have swap questions, give us a call, and we'll try to help you walk through them. But just note that swap values will differ quite a bit, and that typically most cases historically have seen prepayment penalties associated with taking out a swap that a lot of borrowers don't understand. Any questions on that topic before I go to the next slide? Yeah.
You probably can't say because you're in the business. I can, because we did a 10-year fixed rate swap with 5.5. We tried to refinance because the interest rates are lower. The unwind fee was $80,000 on a $1.5 million loan. And to your point, I'll bet you 95% of the bankers out there that are talking swaps don't have a friggin' clue about what the swaps are and be able to explain it to you. So beware.
Yeah, I would echo that advice. It sounds great because the banker will tell you, I can deliver exactly what you're telling me your need is. You're telling me your need is for a fixed rate loan, maybe 10 years, and they'll say there's no upfront fee on a swap, just enter into this separate contract, it'll hedge you. And these are really, really volatile instruments. And they're things that you generally really need to know what you're doing before you would enter into one. So, other questions on swaps? Yes, sir.
Well, are you saying that it's overall more difficult to get a fixed rate in general for a church loan?
No, I think the church, what you see in the church lending world you see really two very, I'm going to say there's 3 very typical products out there right now. There is a floating rate or 1-year adjustable type bank loan that's out there. You've got typically a 5-year fixed rate bank product that's out there. And then you've got a bond product, which bonds will give you between 15, 20, or 25-year fixed rates. But really the question is, the bond product, you're going to see a bit higher rate on it because it gives you that long-term true fixed rate. You never have to refinance it. Bank typically is going to have a lower rate because you have you're taking on refinance risk. You know, the bank is saying to you, look, we're only going to, we're not going to take 20-year interest rate risk with you on this. We're only going to go maybe 5, or maybe we'll go floating. And so fixed rate products are out there for churches. It's just a question of kind of sorting through what your risk profile is and how quickly you think you're going to pay it down. Just to add one more little anecdote to that, if you're taking out a $2 million loan and you have a $2 million capital campaign ongoing odds are very good you're going to pay that loan down very quickly in a 3 to 4 year period. And if you do that, you probably don't need that much in the way of interest rate protection. A 5-year fixed rate bank loan will work great for you. Conversely, go back to that example, if you're a church borrowing $10 million and maybe you don't have a big campaign, maybe that you're a church that has tremendous cash flow and you can cash flow a $10 million mortgage very easily, but you're not going to be able to pay it down quickly in 3, 4, 5 years, then you may want to lean towards a bond product where you have a true, again, maybe 20 or 25-year fixed rate. So it really depends on your individual situations. Let's talk about a couple other factors on accessing the capital markets and navigating them today. Equity or loan to value. The real point of loan to value is how much cash can you bring to the table? If you want to build a $5 million project, can you bring $1 million cash up front to the table? Lenders all have different approaches to this, but at the end of the day, for so many churches, lenders like to see some level of equity coming into the project that the church has provided. Typically, it's very hard to get 100% financing right out of the gate. And so cash is, again, king in church lending. Couple things to note on appraisals. If you go out and get your property appraised, what a lot of lenders are finding, and churches are finding as well, actually all property owners are finding, is that appraisals are coming in at much lower levels on the same property versus what they may have appraised out for 3, 4, 5 years ago. And so that's something to be aware of as you go out to seek financing. Maybe that site that you're going to put the new facility on, that 20 acres that you bought 6 years ago, maybe you paid $2 million for that property. Today, maybe it was worth $2 million, maybe it's worth $2.5 million. Odds are it could, however, appraise out for only $1.5 million. So you want to be aware of that. Also note that the bank regulators are looking very hard at collateral values on all the commercial loans that banks are making. And so you're going to have, some banks are requiring their clients, and not just churches, to have new appraisals done on the properties, just to make sure that the values are within reason. Now, before the credit meltdown, we had a number of lenders in the church finance industry that were doing 80% loan-to-value first mortgages. So if your property appraised out, let's say, for $1 million, they were getting loans up to $800,000 against that $1 million property. And also there was a preponderance of second mortgages that were available in the industry. And so there was, just as with home lending in the subprime home lending world, there were 100% loan-to-value, full financing type transactions being done in the church world. That all changed with the crash in 2008. The bank regulators really got back on the case, and obviously, and property values dropped as well, coming off the bubble. And so the new metric is most church lenders are looking at wanting to have a 60 to 75% loan-to-value as it relates to the loan that they put out. And so again, if you're looking at a building and property that's worth $4 million under a 75% loan to value, a lender typically will lend up to about $3 million against that $4 million property value. Now note that appraised values are obviously subject to stress as new comps show up. And this goes back to the point about that land that you may have bought a few years back. You may have paid $2 million for it. What's happening now is the market, the commercial property market literally froze in place in 2008 and 2009. Very few places were sold, very few transactions were recorded. Well, the market has started to come back here in the past year or so, and with that, a lot of different transactions are taking place. And so what you want to do is look at your property and make an assessment of what other areas, what other properties and parcels around you may have sold for if they did sell in the past year, just so you're not surprised to find out that if you have 20 acres here, you find out that someone a half mile down the road recently sold a similar 20-acre parcel for half the price of what you paid for yours. A lot of these comps that are coming as a result of, again, banks are liquidating properties, distressed sellers are finally able to liquidate properties, and these sale prices are generally not coming in very high. They're coming in much lower than people expect. Now, there's always exceptions to the rule in certain markets, certain communities, but as a general rule, you need to watch out for that. And as noted, don't plan on property appreciation from when you purchased your land. Very, very common for us in the lending world to work with churches 3-4 years ago who would come to us and say, hey, we did buy that property for $2 million, and we can get it appraised for $4 million. And that's where we're going to bring a lot of our equity in for our loan. Again, commercial property has just not appreciated here the last 3 years. In most cases, it's gone down. The other thing that's going to help you when you talk with a lender and be able to get the best possible deal for your church is to understand specifics about your site and your site value. And if you can explain to a lender very concisely with a nice, what I always encourage people to do is when you talk with a lender and you send in a loan package to them, send in something with some really nice pictures. You can get off the internet, Google or Bing, those search engines have mapping functions. You can get beautiful aerial photos of your facility or where you're going to build on. I'd encourage you to send those in. Know for your lender before you go in there, know what the zoning is for your property and be able to articulate to the lender to say, we want to get our loan closed in April, start construction then, but by the way, we need a conditional use permit from our township in order to accomplish this. That may take a few months. If you have some zoning restrictions, you may not be able to, you're going to have to really fight hard with the municipality to get waived or cleared or zoning changed. Know those things so that you can, again, tell the lender on it so you really feel that, you can convey a sense of confidence and that you're on top of your game with every aspect of your project. Good idea to know, if you've got good highway access, talk about if you have good growth demographics or income demographics where your church is located. That will obviously help. Is there zoning available for other uses? A lender loves to hear when you have a client come in to present a loan proposal. If you can say, well, this building we're building is going to be very multi-purpose, could be used as a school, could be used as a corporate office. If something happened to us, we could pack up and sell this to a commercial buyer. Those type of things lenders like to hear because it gives them confidence that the property has multiple uses, potentially other than just a church. Now, that doesn't mean if you want to build a beautiful traditional church, steeple cross all of it, don't do that. Go ahead and do that. Just noting, though, that you may have a little bit extra sway with a lender if you have some more multi-use type property. But it's also good, the other part I didn't mention in here in the slide is know the environmental condition of your property. Most buyers today do what they call phase 1 environmental studies or environmental audits. These cost about $1,500 to $2,000. An environmental engineer is going to look at your property, going to look at the chain of title, and going to walk the property and make sure that there's no environmental contamination that they could see or that was in place. I mean, you want to make sure that there wasn't a dry cleaner located there that had solvents getting into the ground, there's no underground storage tanks, those type of things. So know about your site also in that regard before you go in. Again, you'll look very prepared and it'll be very impressive. Talking about RFPs. RFP is a request for proposal, a package of information that you'd send out to a lender to solicit for a loan. There's some ways that you can make RFPs really, really stand out and pop, and some things that you need to look at ahead of time, and I'm going to go through now a few of these. Just quick get a drink here. One of the stories I always use, and this is one of the first ones I've got up here, is Google your church. Get on the web, go on Google, type in your church's name, type in your pastor's name, and see what comes up in the search results. And go a few pages deep within the search results. Because I could tell you that most lenders are doing the Googling, checking the background. And as the internet has evolved as a source of information, it's amazing what's out there. And I'd give you a true story. We had a church on the East Coast apply for a loan with us, and everything looked wonderful on paper, looked like a great $2.5 million loan. We were very excited. And then I popped the church name into Google. And the very first 2 entries that came up caused me some concern or pause. The first entry that popped up on Google was the main church's website. Beautiful website, had all their ministries, pastor, staff, everything that you have on your website. The second entry on the Google search. The first one was XYZ Baptist Church. The second entry is titled The Real XYZ Baptist Church. And what it had turned out was 2 years prior, this church had gone through a terrible split related to a pastoral matter. You had 750 people stay. You had about 600 people leave and set up a church in exile that worshiped at the local high school. And so I clicked on the second link, and there was a huge introductory page saying, welcome, if you've been persecuted at XYZ Baptist Church and been through the turmoil, come to the warmth of the Spirit at our church. We're meeting at Mountain View High School every Sunday. And so that's the kind of thing that you want to explain to a lender up front before you get into it and try to mitigate it in your RFP and disclose it, because you're going to find stuff that's out there. The other thing to note is that there is always, well, I don't say always, how many of you have an occasional disgruntled congregant? You're the exception. There are so many websites and message boards out there, and if you have just one person who did not like your music or felt they were mistreated on a Sunday service or dissed, so to speak, by your pastor or staff at some point, and they put it up there on a message board, I can't explain it, but for some reason, Google gives that top ranking. It'll be right after your church's website, boom, here'll be some message from 2008 complaining about something. Now, we look at that and we understand that happens from a lending standpoint. But you need to know what's out there just to make sure that it isn't a bigger problem and that, again, it's something that you can explain and mitigate away. Some other things that you want to do on your RFP. This next one takes some time. It is not easy, but it will be an exercise very worth your while and will help you get a loan and better terms on your loan. Do 5-year projections of your revenue and expenses. Project out what your revenues you think you'll take in and your expenses in the new building, let's say from 2012 to 2016, and set it up in such a way in a profit and loss format on an Excel spreadsheet that'll show the EBITDA that's going to be coming through. And so on these slides, you want to be able to show the lender that, yeah, this is how we're going to grow, this is how we're going to pay for the mortgage, this is how we anticipate our expenses and what they're going to be in the new building. And realize that you will have higher expenses in the new building, regardless of all the energy efficiency things you're going to learn about here at WFX to incorporate into your construction. New buildings typically, generally seem to cost more. They're bigger. There's a lot of new things going on in them. There's a lot more AV churches find in their new buildings, and so know what your costs are going to be. And incorporate on the slides, show that you have debt capacity, and this goes back to those tests that we talked about. Show the lender what your debt to total revenue calculation is, show them what your EBITDA calculation is or your debt service coverage, and also see if your 33% test, where that comes in, and can you handle an increase in interest rates if it were to happen down the road. Now, all this takes some work, but that said, the more prepared you go into the lender, the better rates, terms, conditions you're going to get. A couple other things you want to include in your RFP. You want to have data for the most recent year to date. In the past, for a lot of lenders, if you just sent them last year's financials, that was fine. A lot of lenders like to see how you're doing quarter versus quarter, to say how you're doing in the first quarter of this year versus the first quarter last year. So do some internal comparison of your giving week by week. See if it's holding up the same or better versus the last year. The lender eventually is going to ask questions to get this data, so it's good that you've looked into it to see, do we have a weakness this year? Or if you don't, if you have a surplus and say, our income's running up 8% this year. It's a very positive thing to add to your RFP. Capital campaign data. Big part, so many churches do capital campaigns to help facilitate a building and a loan. And so get a very nice one-page summary of your capital campaign data. Have a detailed schedule of your pledges, have the collection status, have the timing of the receipts, break out who the top 10 pledgers were. Now, you don't have to put their names in for confidentiality purpose, but show the amounts of the pledges and what they've given. Again, that's going to give a lender a lot of comfort that your capital campaign is well underway, well received, and showing good results. and it gives you a lot of confidence. And if your data is showing a weak campaign, let's say you went out, you had a First Fruits Sunday, people pledged $1.8 million, you're a year into it, and you've only received $350,000 of pledges. Know that that's going on, because a lender is going to see that, and again, you're going to have to mitigate that to say, well, the reason we're running behind schedule is because of this. Maybe it's the project hasn't gotten underway, the plans haven't been finished, maybe you had a large donor where the donation fell through. But you want to know these things going in ahead of time. Couple things on some strategies to advance the project. We talked about this one earlier, but I can't emphasize it enough. Consider phasing your project. Phasing was very commonplace up until 2003. As noted, Saddleback didn't build it all at once. Saddleback has been a 10, 20-year process of buildings going up at that campus. And so many churches can get by very well with phase one with a multi-use building. I know that the idea of having a gymnatorium that you use for gym during the week and you use for services on Sunday isn't always the most fun thing to do. Involves a lot of wear and tear, a lot of setup. It's not as nice as a beautiful dedicated sanctuary. That said, if your budget will only allow a gymnatorium, they're not a bad way to get going. And again, that's something of talking about multi-use. Then get in the new site, get out to your new location, get worshiping there, because worship facilities typically are what are going to generate the most revenue for you as a church to help you do the other phases. And work on phasing. Phasing is a great way to do it. These last 2 points on this slide really come into play here in the last 2 years. Don't rule out a used building. As with residential homes, there are a number of really good used buildings on the market. And these used buildings are now selling for maybe, I mean, it varies from marketplace to marketplace, but you can find good used church buildings that are maybe selling at 25% of what it cost to build them 5, 10, 20, 30 years ago. And so there's always very good deals out there. You might find that you could get a used building very inexpensively and then build out or even put an addition on that building versus getting a clean new site. The other thing to note is if you've got a big project planned, you may want to take advantage of the downturn in the economy to buy land and sit on it. If you can't afford to do your full building right now, it could be a good strategy to say, well, boy, there's 10 acres we want. That'd be perfect long-term home for us. There's a lot of landowners right now who are sitting on commercial property, vacant land, and they're not real comfortable because the odds are they're probably paying debt service, a loan on it. They're paying property taxes on it. And they're in an economy where their exit strategy right now may be years out, whereas previously it was months out. So those people may want to sell. And so if there's a piece of property that you're looking at in your neighborhood and you've always driven past it, you said that would be a perfect spot to put our church someday, but there's not a for sale sign up on the property. Go to the land records, find out who owns it, see if you can talk to the owner. You'd be surprised how many owners of property that don't have any listings up may consider selling in the current economic environment simply so they can unload the carrying costs of perhaps a mortgage and taxes they may have on the site. So it's not a bad strategy right now to take a look at. Take a look at strategic partners. This is a key thing. As we talk about on the lenders, we've had a lot of turnover and turmoil in the commercial lending world here, especially as it relates to churches. There's a number of players. I think when I was at the National Church Business Association convention in 2007, I think there were 15 lenders in the exhibit hall at that particular conference, summer of '07. When I was at the NACBA in Washington, D.C. this past July, I think there were maybe about 4 lenders. And so there's been a lot of turnover. So as you work with church lenders, ask the bank or the lending organization you're working with, ask them for some track record of loans they've made and funded in the last 60 days to make sure that they've got the capability, they've got the capital to close your loan, and that they're actually out closing loans. The other thing is make sure that you get your approvals from the top and don't rely on banking representatives in the field. And this I would say, again, I don't want to knock the profession that I'm in, but I'm giving you sort of inside baseball tips on this. A lot of times the line level lender may not have the authority to approve a loan or may not have a great feel for whether a loan will get approved ultimately by that bank's loan committee. And so what you want to do is sometimes a sales banking person at the field level may overpromise and then not be able to deliver. And so what I always encourage people to do is say, when you're talking with your rep, no matter how great they are, say, hey, could we have lunch with you and your boss, next person up? Boss may be on the loan committee, and bring that person in, because that way you've got someone higher up also promising you, potentially promising you, rates, terms, and conditions. And so you don't feel like you were told one deal was going to happen, and then you find out that it got to loan committee, and you got a completely different deal presented to you or approved than what you thought you were going to get. Contractors. Contractors, there are a lot of great contractors in the WFX hall, a lot of great design build firms. Encourage you to visit them all, vet them all out. The key thing to note, though, is that in down economic times, a lot of contractors go out of business. A lot of contractors don't necessarily have capital to finish projects. So it's more important than ever in down economic times to really due diligence your contractors. And so how do you mitigate this? What you want to do is ask contractors you're going to work with or potentially work with, ask them for some current financial statements, ask them for some background on their ownership structure, request a list of similar projects they built, ask them to give you a letter from their bank verifying their good standing with their bank and their credit lines, maybe get a letter from their surety bonding company. Are they bondable on the project? Those are things that any good contractor will gladly provide to you. And it's very easy for them to do. For many commercial clients, they've typically got a whole package with all these things up to date that they can provide you with. But if you ask your contractor for these things and you don't get them, it could be a big red flag. And last thing you want is to get the loan closed, get the building under construction, and find out your contractor can't deliver and maybe goes bankrupt or insolvent during the process, or maybe some subs do. Last couple slides here. Straighten up your own house. One tip that I like to always tell people about is if we get loan packages come in and loan requests from churches come in to us as a lender all the time, every day of the week. And I will tell you that the ones that go very first in the pile to look at are churches that have financial statements that have been prepared by an outside CPA. Now, there's really two choices when you put together financials. You can take your internal financials, which may be in very good shape. Some that we get in look like 1 million receipts in a shoebox. They're hard to assemble together. We like our jobs to be easy. Everyone likes their jobs to be easy. And so if we get a package in that's got a shoebox with months of financial data, and it's this thick, and we have to reconstruct it to figure out what the church's yearly cash flow is, we're probably going to put that application aside for the moment and take the one where there's some CPA-prepared financials that are 2 or 3 pages long, really easy to understand. I would tell you that just spending a couple $1,000s to have a CPA come in and do a compilation balance sheet and statement of activities for your church will pay off considerably with a lender in the rates, terms, conditions that you get. Because from the lender standpoint, it's easy to understand. It also tells us that you've had a third party come in and in effect review your financial statements for accuracy. It's not guaranteeing they're all accurate, but there's that third party review there that gives us a lot of confidence. Couple last things here as we're closing out on time. Examine your bylaws to see what type of congregational accountability you have. It's a little bit harder to get loans funded if your governance structure is set up that the board is maybe the pastor, pastor's wife, and church secretary. Lenders like to see that you have some level of lay leadership. Doesn't mean that you can't have an elder-run church. Doesn't mean that you can have, for many churches, they have a lot of the decisions are made at the elder board level as opposed to down on a congregational vote level. Those are all okay things, but as a lender, we do like to see that there are a few lay people who are involved in some of the major decisions that go on, so that can ensure some continuity if something were to happen to the pastor of the church. Tying into that, make sure as part of that you have a steady and experienced board or board of advisors. Think through a pastoral transition. For so many church lenders, the big risk is key man or key person risk if something happens to your pastor. be able to explain to the lender either why your pastor is not necessarily so key that the church would not crumble if something happened to that person, or think through to say, we've got a pastoral transition plan figured out. If our minister were to be called elsewhere, something were to happen, accident, death, disability, we have these two pastors that preach 15 weeks out of the year, congregation loves them, they could step up. You want to think, that answer may not be perfect for all churches. There may be a lot of faith that both we as the lender and you as the church take in those situations, but at least think through the question. Make sure all your own accounts are invested properly. Make sure that your bank accounts that you have, we encourage you to have the full FDIC coverage, even if that means you've got to spread it out to a few different banks potentially. Make sure you have impartial advisors, and all those things stack up, again, to show a church that really knows what they're talking about. So to wrap it up before questions, talk with lenders about safe debt loads, and do that concurrently in the initial stages of formulating your project. Don't get way down the road and let the horse get further out before you really understand what your debt capacity is. Great news is funds are available for churches that are prepared to borrow. Interest rates have never been better. Before you approach a lender, make sure you understand those numerical borrowing tests that we talked about, and how they, how your church interrelates with those tests. And then also, we've talked a little, one of the other themes I think you've seen of these last few slides is think through all the potential weaknesses in your loan application and be able to mitigate them, again, before you sit down with the lender. And so being prepared is going to greatly help things and guarantee success for you. So with that, I'd be glad to take questions that people might have. Yes, sir.
How is your organization different than a bank?
Good question. With a bank, the bank is obtaining money from people who deposit funds in the bank, and the bank takes those funds and then will lend them out to you, the church. The people who deposit the money into the bank can at any time pull the money out of the bank. You think about it, you go down and you withdraw it out. Because of that dynamic, banks typically will fix interest rates on loans no more than 5 years. And the reason for that is they're concerned that if interest rates go up, we're going to have to pay a lot more money to these depositors to have them keep their money in the bank on deposit with us. With our structure, with a bond structure, what we do is we have investors who are willing to take small pieces of a loan, ownership of them through a bond. And because they're taking small pieces, they're generally willing to take long-term interest rate risk, so that they would take, and go back to the example of a church that borrows $2 million from the bank is at risk for all $2 million. If something goes wrong or interest rates rise, they've got the whole thing. With a bond structure, the ownership positions of the loan are dispersed across many, many people who have small pieces of it. And so they're more inclined to take long-term interest rate risk with you. Now, that comes with a price in that your interest rate cost and origination cost typically is a bit higher with a bond issue than with a bank note. And that's where you have to weigh out your interest rate sensitivity and what you're most comfortable doing.
Interest rate usually more for the bond?
Interest rates, it depends. In the current marketplace, yeah, the interest rates are a bit higher right now with a bond. And the reason for that is the bond investor is saying, I'm going to take an interest rate and credit risk on this church for perhaps up to 20 or 25 years. And so let's just say rates bounce off these all-time lows that they're at and go up 2 points. All of a sudden, that investor is locked in, though, to that rate for 20 or 25 years. They can't get out. The bank depositor, if rates go up, you can withdraw your money and get out. And so to compensate that bond investor for taking that long-term interest rate risk, they get a reward with a little bit higher rate of return. For you as the church, what you have to weigh out is the interest rate sensitivity of if we take the bank loan and it resets at 3 points higher, can we afford that in our budget? That's the thing you need to look at. And also you have to take into effect, will we be in good shape enough to get our loan refinanced in 5 years, or will our bank be in good enough shape to refinance? So there's a lot of different variables in there. No right or wrong answer. Yes, sir.
How does the commission on bonds compare to the points on a loan?
Typically, you're going to have a higher commission on the bond structure, because what we do with the bonds is we have to sell them through to a number of different investors, and in effect have to pay commissions to be able to do that. The difference, though, is that when you pay the commissions, again, it's a part of a trade-off. Bond structures typically do not have any prepayment penalties on them. And so it's kind of a case of you have to weigh out what you feel is, again, best fitting with your ministry and your cash flow. For some churches, going to the point, I think the gentleman who took out the swap is not here with us anymore, but to go to that point, he took out a swap thinking he had a great rate, was locked in for 10 years, and all of a sudden when rates dropped a bit, he wanted to refinance, and he found out, wow, I've got an $80,000 prepayment penalty I had no idea existed. So it's a real trade-off, again, between what what your goals are and what your cash flow looks like. Yes, sir.
How do you look at operating expenses as an additional cost obligation of the church over and above debt service?
That would go back to that slide that we talked about that had the EBITDA on it. And what we really like to see is a church that has exhibited at least a year's track record of being able to generate some level of surplus over and above your operating expenses. Does that answer your question, or do you have some, am I maybe missing a nuance there?
No, I think that's okay.
Okay.
You're taking it from the income side. You're not considering it in your formulas. You've got a 33% formula.
Mm-hmm.
That's only for debt service.
Right.
You add operating expenses. Your facility costs rise into the 40s for.
Correct. You're right.
So that doesn't concern you.
Well, it concerns us when you get beyond a certain level. When you get up, that 33% is a good one for the debt service. And then you got your facilities costs, maybe you do go to 40. Where we get concerned is if you get up in 45, 50, 60%, because then you clearly, well, I shouldn't say clearly, but in most cases do not have enough cash flow to really sustain a quality ministry. That's one part of it. The other part of it is you probably would be very hard-pressed if you took a hit to your budget. If the economy in your area really worsened, you had 10 families lose their jobs, your giving went down, you just would not have a cushion to keep making that mortgage payment and funding your other expenses. So, other questions? All right. Well, oh, yes, sir.
Your bond investors, those are independent investors that you all would get. They're not necessarily investors from within the church?
They can be within the church. It's really your option. If you have investors who want to invest, we handle that and can encourage it. If you say we'd like to get the funding very similar to a bank loan with no congregational involvement, we can do that as well. So, yes, sir.
What is the typical rate going now?
Tell me what, there's so many different structures. I mean, I'll give you some benchmarks here. Typically, you can see one-year loan rates can be in a 2 to 3% range right now. I mean, again, you may have some churches that are getting much better than that, may get a little bit worse, depends on what your credit is. 5-year fixed rate loans typically right now are going out in about a 4.5% range, again, give or take, incredible lows. On a bond structure, we're looking right now at a 15-year fixed rate at about a 5.5%, and then about a 6.5% for a 25-year fixed rate. And so that gives you sort of an idea of the spectrum out there right now. The good news is no matter what option you choose, these are just absolutely unheard of rates. And we're in such a strange economic time right now, and at some point, these things do change, and they will change. And so you just need to be prepared for it and take advantage of it now, but be prepared for changes down the road. Today, the Dow Jones closed down almost 400 points on concerns of Italy, because Italy is now falling apart. They can't fund their government, and so the yield on Italian government bonds shot up over 7% today, and it was much, much lower just a couple months ago. So, these things can change in the U.S. as well, too. Yes, sir.
What percentage of the loans are fixed versus floating, just for your customers?
Boy, I don't know that anyone's done a study on that. It's really hard to say. It also depends on the economic conditions at the time. At current low rates, I mean, what's happened, what's interesting now is a lot of churches are in short-term, either floating or very short-term bank deals, and they would love to get out of them, lock in long-term with some type of bond structure. But the challenge is their bank note may be at 5% and the bond rate may be at 6.5%, and they can't afford in their budget to take that increase in debt service to move into a long-term fixed rate. And it's very much of a catch-22 because if and when rates do go up, you're going to have to catch that anyways at that point. And at that point, you'll have missed locking in long-term with the options. So, I mean, it's kind of going down the middle right now. All right. Well, thank you, everyone. I appreciate it. And if you want slides, again, I think there was a sheet that's passed around. I'll get them out to you direct. And also evaluation forms. Please fill them out. Thank you.